Okay, so good morning, everyone. Welcome to today's edition of the Macro Snapshot. We are Friday, November the 10th, 2023. Okay, guys, so let's just look at a couple of charts. First thing I just want to say, just in terms of data, we don't have a huge amount of news or data yesterday. We had plenty of action yesterday. Just for the record, I mean, if we just look back at yesterday, we had the initial jobless claims, which came in, essentially in line. This is historically still quite a strong, like a supportive number. So it's a relatively low number. Some commentators like to say that the continuing claims did kick up a little bit, pick up a little bit, forecast at 1820 up to 1834. But, on the other hand, revised down. At the end of the day, although we could say that continuing claims could be indicating that, although the job market is strong, people who do lose their job, they're taking a little bit of extra time to find another job. So at the margin, that is slightly sort of dovish. Or sort of negative news for the labor market. But at the end of the day, if you put together the initial jobless claims and continuing claims from a historical perspective, it's still indicating a strong labor market. Let's just put it at that. And I think that's what Powell was alluded to later in the day. In terms of today, not really a huge amount. We do have preliminary numbers for Michigan, University of Michigan. I would say the one which is the most important is probably going to be the one-year inflation expectation, still expected at 4%. Now that's meant to be lower than last time, which was 4.2%. But as Powell himself said, they're still a bit nervous. And, we have CPI next week. And the idea is that the headline CPI, whilst that might be coming down, the core number is still, it's still above the Fed's sort of mandate at 2%. And so the thing is, maybe the market just wants to keep a bit of an extra eye today on the one-year inflation numbers, just to see whether, in fact, maybe Powell was a little bit overly cautious yesterday or overly aggressive. So apart from that, not a huge amount. What we did have yesterday, of course, was the 30-year auction. So just to put this into context, I showed a few of you guys, but basically, if you look at the sort of historical what's considered auction sort of tails and stops here, we can see that if you look at the 30-year, I mean, we basically had a 3-year auction on Tuesday, which went relatively well. The 10-year did tail by almost a basis point, but the market chose on that occasion to ignore it. But what we had yesterday was a market which clearly is signaling to maybe the US Treasury that it's finding it difficult to digest this huge amount of issuance. And I know everyone got very excited with the QRA, the quarterly refunding announcement we had the numbers last Monday and last Wednesday. And for sure, those numbers were a little bit lower than expected. But the reality is that the US Treasury is issuing a huge amount of debt, and that it's relentless. It's relentless. It's every month, and it's going to go on for the next quarter or two. And yesterday we saw the first signs of indigestion. But just to put this into context, if you look at the orange kind of bars here, which is the 30-year bond, you see that anything either a sort of a stop through or a tail, anything above 2 is relatively unusual. Anything above 3 is highly unusual. And let's say like a tail here of -3, as you guys can see, going back to, let's say, 2022. So going back, I don't know, what's that, 15, 18 months or so, you can see that, in general, the range of misses or beats is, within the 1 to, maybe 2 basis point kind of range. So anything over 3 is pretty unusual. Yesterday, we got over 5, about 5.5 basis points tail, which basically means that the demand, the buyers essentially were saying to the US Treasury, the market was saying, hey, we want an extra 5.5 basis points to absorb this supply. So that is a huge, like historically, a very, very, very poor sort of performance, and the market signaling that they're overgorging on bonds. And if we actually just look here, also the bid to cover was lower than expected. This is the average metrics, for the last previous 6 months, not including yesterday, of course. And basically the indirects was lower than this. The bid to cover was lower. So the bottom line is that it was a very, very weak auction. And as we can see, if we just look at a couple of charts here, just look at the reaction. I've got a 3-minute chart here. Just look at everything. So essentially, let's say take NASDAQ, for example, just on the futures here. We can see that at 1 p.m., which is this line here. So boom, went straight down. Now it did recover. This is interesting. It did recover almost back up to P1, but the initial reaction was pretty bad. We can also see the initial reaction, obviously, if we look at the long-term bonds themselves. So let's look at the 30-year bond. Very, very nasty fall here. I mean, and what's interesting here, and kind of maybe even more disturbing, is that the bond market, generally going into an auction where there might be fragile demand, does like to build in a concession. And what's pretty extraordinary, at least for me, is that if we look at the overnight, starting from the European session yesterday, let's say 1:30 our time, Eastern time, 1:30, you can see here that the market built in a very, very aggressive concession leading into the auction. So let's say we go, I don't know, we can look at, like 2 o'clock in the morning when the European session is kind of getting underway until the auction itself, 44 ticks, which is what's that, essentially like a 1.5. So a point on and a half. So the price was lowered, building in a concession in this kind of sort of time frame overnight. So already the market was signaling that they were nervous and wanted, a nice discount essentially leading into the auction. And then boom, the auction itself even tailed. So like a very aggressive fall there. Now, again, it did sort of come back a little bit. We can see on the yields rising there. So obviously, as the price goes down, the yields are rising there. We can see that, for example, the dollar index just based on the auction there at 1 o'clock also going up. But again, what's kind of interesting is that some of these moves were retraced. So maybe it was like, okay, we could deal with it. But then of course, or just let's just look at the yield curve, and we can see that as those long-term yields pushed up high, that caused a pretty nasty sort of bear flattening. So if we look at something like I don't know, maybe 30s twos, for example. Quite interesting to look at just the yield curve sort of action yesterday. And we can see that on that very, very weak auction, we can see that the long-term yields pushed up, very, very aggressively compared to the front of the curve. So of course, that's going to bear steepen the curve. But again, what happened is that the market just had, essentially, 55, 60 minutes. And then, of course, we had our friend close the effing door, Powell. I thought that was quite amusing. Jay Powell, his feathers were ruffled and fluffed up a little bit. Just as that climate protest ushered him off the stage for a little bit. Anyway, but then Powell came out, and what's interesting for me is that he didn't really change enormously the central messaging from the his comments at the last FOMC meeting. But I guess it was like a sentiment, it was a change in tone. I think it was just a readjustment in tone, and essentially he said that whilst he would be cautious, that he would have no problem at all in hiking again, if necessary. Secondly, he said that there had been, what did he say, head fakes in the past about inflation. So, and then thirdly, basically saying that, a few months of data did not necessarily sort of seal the deal. So essentially, he really tried to push back to the market and just say, whoa, like, I get it, the data is looking, relatively supportive, but there have been head fakes in the past. I need more data. I will raise rates if necessary. Now, does the market believe him? We have to look at the reaction, but certainly he did want to push back. And I think we have to put this in the context of a stock market which had gone up historically. Like last week, it went up 5.5%, the S&P, and as we were talking last week, that on a historical basis is in like the 98th, 99th percentile. So essentially a very, very overextended market, and a market which had moved very fast and very hard to the upside. We also had financial conditions weakened, and I think Powell just decided, enough's enough. Let's just calm everyone down. Now, whether this has followed through, we'll see. But certainly, we got a pretty nasty reaction. Let's look at the reaction, and the main focus today is, of course, is going to be to see whether the market sort of pushes through on this, continues through this. So we see here, instead of having the bear steepener, we had actually a bear flattener this time, as the front end yields kind of ripped higher, just on this idea that maybe the Fed was not completely done. So we had so it's very hard at this point to hold trades for more than half an hour at this point, because you're getting steepening, flattening, everyone's being whipped around, and a lot of people just talking about that. A lot of people saying that some of the recent sort of upward moves have on the yields has been essentially steepeners being unwound. A lot of people under sort of a lot of pain here, just having to sort of offload their shorts in the long-term bonds. So a bit of a sort of a short squeeze. So it's tricky. But just looking at the price action here, so just on Powell's comments, obviously we see, again, we can look at something like the ES. We see that the ES on Powell's comments yesterday came down, very, very aggressively. So we see here, this is on the back of the 30-year bond. It retraced a little bit, then Powell bang. But, again, the low overnight was, just sort of in the APAC, Asia Pacific kind of session, a little bit of positivity in Europe, but coming off again. So I guess what we really have to be looking at today, again, not a huge amount of data except for University of Michigan at 10 o'clock. The first thing I think is just these recent highs. Let's just see, 43.66, 43.73. That I think is going to be, on a very simple sort of day trading kind of perspective, just the first things to be looking out of. And that's going to be the first hurdles. Can the market at least get back a little bit higher than that? But definitely we saw the ES selling off. We saw NASDAQ, obviously interest rate sensitive, selling off, trying to stage some kind of recovery, but the market is definitely fragile. We see the dollar. If we look at the dollar, the dollar sort of, at highs. No, I don't want to say, sorry, not at highs. The dollar having a nice reaction. So again, just ranging here, and that's going to be the story of the day. Can the dollar maintain its energy? The one which I do want to look at though is gold here. So gold selling off. So gold is very curious to me, and that's why I did have a gold short, but I have to say I did cover at a certain point yesterday, just because the fundamentals, its relationship with the dollar and the real yields they seem to me to be a little bit odd at the moment. And I mean, now it's starting to drift off a little bit, but yesterday the reaction I thought was quite odd. We had, on the as the yields were ripping higher, we see that gold actually went higher, and then as Powell was sort of hawkish, I mean, gold came down a little bit and then started to drifting. But just overall, gold for me is a bit of a head scratcher at the moment. Although if we start looking on a daily chart, let's look at a few daily charts here. If we go to sorry guys, just to put this on this one here. If we have a look at gold here. Just let me scroll down and find gold. I can see here, it's come down. My judgment was that, the move here was down to a 38% fib retracement, and that had more or less been sort of achieved, and that's why, it bounced yesterday. That's why I covered the short here. Now, could it go down more? Absolutely, but I do think that the first resistance here at about 1945, 1946 on the GC1 kind of contract, that's going to be interesting. If the bulls want to step in, that'll be the place to buy it. And I do believe that actually, if you look back, this is quite an interesting level here. That could even be a buy. But for sure, if it pushes down through there, maybe the market is worried about higher real yields, a stronger dollar, potential risk of hawkishness from the Fed. Yeah, I mean, it can sort of go down to that 50% retracement, 1925. So that's definitely something I'll be looking at. In terms of the equities, just let's put it on the cash index, the SPX today. Again, that in retrospect, that's a pretty strong resistance here, and no surprise yesterday that the weak auction and Powell's relatively sort of hawkish sort of tone, at least we'll see if he follows through with action. The tone, they're definitely we're ripe here for some kind of maybe like a fib retracement. So if we hold on, let me just move this one down a little bit. If we look, I'm sorry, guys, I just want to find my retracement tool here. So if we look, let's say fib retracement, for sure, the first barrier is going to be this sort of uptrend line. So that's going to be on the SPX, maybe 43.14. So that's be the one to be looking out for. And we can also throw on, let's say, a few moving averages, see what the next one is. So probably this cluster of the 200, what's that? That's the 100-day moving average here and the 50-day moving average. I think that's going to be pretty key. And if we put it, let's say, on the futures, ES1, you can see that we've already got down to that level. So I think that's going to be the first test today, which we definitely need to be looking out for, is that exponential moving average, that cluster here of the 50 and the 100 looks to be like a certain congruence level there. You see it's like 43.54. That's the first one to be looking out for. Then, as I said, probably be throwing on a few of the sort of fib retracements here. But I think that's the first one. Let's see if the bulls take that a little bit higher. One thing I will be looking at to get a bit of a sort of a read on that will be just to look at just sort of pricing for the Fed. So if we look at a few different sort of metrics at that, we can see that if we look at the SOFR contract, so that's the 3-month, the short-term ones. And what I like to look at here is the Z3, so December 23 subtracting December 24. And you can see here just on the 3-minute chart, is that what this is essentially giving you a bit of a snapshot of what's priced in terms of cuts from the end of this year, so December 23 to December 24. And you can see here that as recently as I don't know, a couple of days ago or so, go back to the 8th or 9th of November, we had almost 100 basis points priced in. So you see down here, 98 basis points priced in. So that's equivalent to 4 cuts. And you can see that with the auction, but especially Powell's comments here at 2 p.m. yesterday. Again, this is a 3-minute chart. You see, we at that point previous to Powell, we had been pricing in 92 basis points of cuts, but boom, he took it down about 10 basis points there. So almost like half of the cut was priced out. It's subsequently sort of stabilized a little bit, but certainly, in the last couple of days, we've gone down from four cuts being priced in for 2024 down to, well, let's call it 3.5 between friends kind of thing. So definitely a little bit more hawkishness there. That's something to be looking at. It's an interesting trading opportunity to be trading that kind of spread. The other thing to be looking at here is just what I'm looking at here is the pricing in for the January. And so I think even if Powell, it's likely they may be paused, let's say in December, they don't want to be the Christmas Grinch, but maybe in January, if the Fed were to move one more time, maybe January could be an appropriate moment. Keep in mind that next year we start to go into a US election cycle. The Fed historically does not really like to get mixed up in sort of politics, although it's intimately involved in politics, but it doesn't like to give the perception of favoring the incumbent party or the opposition. So that's another issue, is that you'd have to say that does Powell want to be doing, sort of significant action, especially in the second half of next year? That's a whole other thing we'll talk about more next year. But just looking here, guys, you can see that prior to Powell yesterday, we only had 4 basis points of hikes priced in for the January 24 meeting. This is the Fed meeting. And you can see when he spoke here, boom, went straight up from 4 basis points to about 6 basis points. So not a huge amount. I mean, let's not get, what's that cliche, over our skis. But basically the market definitely taking that, slightly hawkishly. It's given back, half a basis point or so. But definitely the market just a little bit more on alert. So the thing is, that's pushing up the yields. In, all things considered, this should be, relatively supportive for the US dollar. It should keep the equities under a little bit of pressure. We don't have anything particularly to change the equity market today. So my best bet would be that the equity market, if it can get through the first hurdle for the bears, pushing down this 150-day moving average, pushing down below that, then we might have a bit more downside. We shall see. VIX obviously up just a smidgen there. That was an interesting one. VXX. Interesting here. Let's see if the market goes down. We could see a bit more upside in volatility. Final thing I want to look at here, guys, is oil. Quite interesting, having a little bit of a bounce. Let's see if this can be sort of sustained a little bit. We see here, well below all the moving averages, which is the orange lines here. The first, barrier we do have a little bit of resistance here. This is on the CL1 contract, 77.25. What got my attention yesterday? So the thing is, gold, oil is quite oversold. I've been doing a lot of research, reading about the demand metrics. Basically, we had the Saudi energy minister yesterday, ABS, out and sort of saying this is just speculators pushing, it's oversold. The market is much more imbalanced than this price action should warrant. I mean, if you look here at something like a Fibonacci extension, I've been looking at this quite a lot. You can see that at least this kind of Fibonacci extension from the top of the move, it is done. In theory, it's over sort of sold here. So, I think a little pushback here is to be expected, but this is just a reactive bounce. Certainly according to the Saudis, they're saying, hey, the market, the demand globally is, not horrendous at all. It's, maybe softened a tiny bit, but certainly that's being balanced by significant supply cuts. And what has got the market's attention in the last couple of days, there's been a lot of chatter that, sort of exports from the Russians has been higher than expected, and supply has been higher expected than from other sort of OPEC plus members. But what the Saudi oil minister was saying yesterday is that this is a seasonal thing, and normally, in sort of October, November, exports do go up a little bit. There's a little less demand. It's just a slight, it's a completely normal seasonal, calendar kind of blip. So let's all calm down. We shall see. The market will decide. I think really, to be honest, at this point, you're going to have to start. I'll throw this on a 4-hour chart. And I think at this point, probably the easiest thing to do would be just to sort of start saying, well, okay, what do the bulls have to do? So I'd say, for me, the first thing the bulls need to do, just on this recent sort of down impulse at least, the first thing at the very minimum, I would say is a couple of things. They have to get above this horizontal resistance, around about, I don't know, as I say, it's about 77.25, 77 and a quarter, around about there. They have to push through that. And then, on this recent impulse here, there's another sort of level here at about 78.80. But basically, they have to start clearing some of these fib retracements. So the first one, I would say the 38%, which I like to look at 78 and a quarter, then the 50%, the 79.20, and then, let's call it about $80. So there's quite a few hurdles. And I would say at this point that the bears are still, at least in the short term, in control until and unless the bulls can push this, up through these 3 or 4 hurdles here. And it's only really, I would say, the first positive signs would be, to be honest, above, I would say, this fib retracement here, which is a nice level, about $80.30. Let's call it about $80.30 on the front contract here. Because if you look at a couple of other things, we can see, if we just look at a couple of curves, just a final thing here. If we look at the curve, you can see that this is, now fractionally in contango. And if you put this, compare this, let's say even to like a week ago, you can see that this curve is not going in the right direction for the bulls. For the bears, it's going in the right direction, but for the bulls, this is definitely not going in the right direction. Oops, what's happened here? Sorry, guys, a bit laggy here. But if you see like the WTI curve, you can see how not only has the outright price come down, but the shape of that front curve is flattening. And that is not good at all. We're in a bit of contango there by a cent or two. And so that's something which is a bit of a worry. We shall see today. Okay, guys, I'm going to leave it there. As I say, the main thing to be looking out for today, apart from whether we do get follow through and continue weakness in the equities, let's see how the bond yields go. The shape of the curve, does it continue to bear flatten? We're looking at oil. So a few interesting things. It's a relatively clean market today, not a huge amount of data. We get a couple of Fed speakers, but I think after Powell yesterday, we're a little bit sick of all of those. And that's it. So have a great weekend, and we'll be back next week. We have CPI, of course. We'll be talking about that later next week. Thank you.